Over the last decade, international ETFs have massively lagged the US market. So why would anyone willingly buy VIU instead of just loading up on the S&P 500 VFV? Well, this ETF quietly returned more than 30% in the last year alone, holds nearly 4,000 companies across developed markets, and may solve one of the biggest concentration problems facing Canadian investors today. So in this deep dive, we're going to look under the hood of Vanguard's VIU ETF, what's inside it, how it behaves, the risk most investors overlook, and whether international diversification is still worth it in 2026. Let's do this! Welcome to the Mr. Financial channel. I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on social media hype. If this is your vibe, subscribe. Let's start with an overview and performance of VIU. And you don't want to miss the last section of this video where I discuss the catch of VIU. Its heavy exposure to Japan, how currency fluctuations can completely distort your returns, and why investors in these markets once waited nearly 6 years just to recover from a major drawdown. So let's begin. What is VIU? VIU is Vanguard's FTSE developed all-cap X North America ETF. In plain English, it gives you exposure to developed international markets outside of Canada and the US, places like Japan, the UK, France, Switzerland, and Germany. It currently holds 3,682 stocks across large, mid, and small cap companies. It charges a 0.23% MER and manages almost $10 billion in assets. It has a yield of 2.5%, was launched in December of 2015, and is rated as medium risk. Despite holding thousands of companies, as you'll soon see, the fund is far more concentrated than most investors realize. All of this information is easy to see on the main page of VIU. There, you have quick access to other essential documents such as the prospectus, ETF facts, the annual MRFP or Management Report of Fund Performance, and annual financial statement. It is good to review these documents before making a decision to buy VIU or any ETF. So with nearly 4,000 holdings and exposure across developed markets, you'd expect fairly stable long-term returns. But the actual performance history of VIU tells a much bumpier story. Using the most recent data from Vanguard, which is as of April 30th, 2026, since inception, VIU has returned 8.8% annualized. Solid, but nowhere near the dominance we've seen from the US market over the same time period. And that's exactly why international ETFs like this spark so much debate amongst investors. Imagine holding an ETF for years while watching the S&P 500 completely leave you behind. That's been the reality for many international investors. International diversification has felt unnecessary for so long that many investors now mistake recent US dominance for permanence. Its 10-year return jumps up to 10.1%, 5 years 11.3%, 3 years is getting really good at 17.3%. And over the last year, 30.8% by market price. International ETFs are back in style lately. Honestly, this is what makes international investing psychologically difficult. You can look completely wrong for years and then suddenly outperform in a massive way. One strong year can completely rewrite investor sentiment. That's how recency bias works. As I usually do in my deep dives, I'll add some color to the performance by starting zoomed out and then zooming in on the time frames. VIU has 140.5% cumulative return since inception. This is how it looks to get that 140% cumulative performance year by year. Of the last 10 full years of performance, there were 3 red years, the worst being 2022 at negative 10.6%. The other 7 positive years had 5 double-digit gains, 15.5%, 15.7%, 19%, and 28.4% last year. Remember, the average annual compounded total return is 8.8%. And this is how bumpy it was. This is normal for equities in the developed market outside of North America. Now, here's where things get psychologically difficult. On paper, Diversification sounds easy, but once you see how volatile developed international markets can actually be, you understand why many investors abandon these funds at exactly the wrong time. Here are the quarterly returns. Similar pattern. 11 out of 41 quarters were negative, with Q1 of 2020 the worst at negative 16%. The best quarter was 15.6% in Q4 of 2022. Only 3 years had every quarter positive, and again, really bumpy. And lastly, let's zoom out to the monthly returns of VIU. 47 of 124 months were negative. That's nearly 38% of the time. The absolute worst month just happened in March of 2026, worse than COVID. The best month to date was 12.2% in November of 2020, and the second best was 10.6% in November of 2022. There were many really strong months over the last 10 years. This just highlights for me why trying to time the market is incredibly difficult and requires a lot of great luck. Just missing 1 month or 2 months of incredible returns means you would have missed out on a huge percentage of that 140% cumulative return. The market doesn't reward patience smoothly. It rewards patience violently and unpredictably. To highlight how bumpy returns are, look at these 3-year annualized rolling returns. If you're fairly new to VIU, you might get persuaded by recency bias and think returns are crazy good for the developed markets, peaking at 22% in September of 2022. The opposite could also be true. If you invested earlier, it's possible your 3-year annualized rolling return was negative 0.8% in September of 2022. Take a look at the management's report on the fund's performance at the end of 2025. That's something you want to look at before buying a Canadian ETF. You'll notice the ETF is always underperforming the benchmark index by at least a few basis points in the annual compound returns. As I already mentioned, VIU has a total cost of 0.23%, so we should expect to see it trail its benchmark by at least that each year if all else were equal. However, there is the currency conversion that has to be taken into consideration, and a tracking error which is currently sitting at 0.16% according to Vanguard. I'm sharing this to give a more complete picture of VIU. It's easy to get persuaded by recent performance. And looking at that green line, that's compared to the total Canadian market, just for reference. By the way, if you appreciate deep dives that go beyond surface level ETF hype, hitting the like button genuinely helps this reach more DIY investors. Thanks for doing so. Now back to the video. So despite all that volatility, investors who stayed invested were still compensated over time, not just through price appreciation, but through distributions as well. And this is where total returns become really important. A lot of investors focus only on yield, but with VIU, the majority of long-term returns actually came from capital appreciation, not income. Let's look back at the annual total returns of VIU. Do you see that income return NAV? It ranged from well over 3% some years to as low as 1.8% in 2016. The majority of its return is from capital returns, of course, like I mentioned, which is great for delaying taxes in a taxable account. VIU currently pays 10.4 cents a unit. As I mentioned, its trailing 12-month yield is 2.5%. It was over 3% not long ago. Then VIU had that crazy run last year of almost 30%. The annual distributions have a CAGR of 9.2%, which is pretty amazing. The majority of the distributions have been foreign income. Sometimes there are capital gains here and there. That's what happens when there's portfolio turnover. Last year it was 4.2%, and as you see, it resulted in only 17 cents of capital gains per unit. And once foreign withholding taxes enter the picture, your actual realized return can look very different depending on which account type you hold this ETF in. That line, foreign tax paid, is what the fund already paid before distributing the cash to you. The tax rate is right around 10% that the fund is paying when you divide the tax paid by the foreign income. You then have to personally pay taxes on top of that in a taxable account. With that in mind, you would not have reached the full 8.8% annual compound return if this were in a taxable account. Keep that in mind. But performance alone never tells the full story. To understand why VIU behaves the way it does, we need to look under the hood at the fund's characteristics and factor exposure. This is what Morningstar's factor profile looks like as of the end of March 2026. What stood out to me the most was how stable most factor exposures remained over time, except momentum, which became far more volatile during recent international rallies. Now, naturally, after a huge recent run, the next question becomes, are developed international markets still reasonably valued? Or are investors arriving late to the party? To answer that, we have to look at the price-to-earnings ratio. The current PE ratio for VIU is 17. Compared to the US market, VIU still looks relatively inexpensive on a PE basis, but cheaper doesn't automatically mean better future returns. However, as we noted before, price fluctuations are common. Earnings can fluctuate as well. So when looking at all the data on performance, distributions, value, and so on, these are all backwards-looking metrics. We don't know what the future will hold. Now, this next part completely changes how many investors perceive this ETF. But what completely changed my perception of VIU was realizing that this ETF isn't nearly as diversified as the headline number suggests. VIU is currently holding 3,682 stocks. Unlike the S&P 500, where a handful of mega-cap companies dominate returns, VIU spreads risk much more aggressively. But that diversification comes with trade-offs. The top 10 holdings make up just 12.9% of the fund. Its top holding is Samsung Electronics at 2.3%. For a little comparison, the top holding of the NASDAQ 100 is NVIDIA at 8.5%. Did you notice that the top 10 is made up of companies from various countries? And some very recognizable names like HSBC, Shell, Toyota, AstraZeneca. The top 25 holdings make up 21.6%, and the top 50, 32.3%. And looking at the top 1,000 stocks, they make up a whopping 1%. And the next 1,000 make up just 3.3%. I'm mentioning this to highlight the effective number of stocks, which is a lot less than the 3,682 stocks suggest. This is a perfect example of why headline holding counts can be misleading. And once you break down where those holdings actually come from, you start realizing this fund is making some very specific geographic bets. This is what Vanguard's VIU looks like right now. There are 23 countries in the FTSE developed all-cap ex-North America index. The FTSE's index is a little different from the MSCI's EFA index. FTSE includes South Korea and Poland in the developed market, whereas MSCI's EFA index does not and includes only 21 countries. And South Korea has done exceptionally well of late. See how steep that curve is? It's up over 200% in the last year. 200%! South Korea's recent surge is one reason why VIU has behaved a little differently than some competing international ETFs. VIU's largest exposure is to Japan at 23.3%, then the UK at 13.7%, France at 8.4%, making up 45% of the fund in those three countries. The bottom 10 make up 7.5% of the fund. The regional exposure, maybe not quite what you expect, with it nearly 60-40 between Europe and the Pacific. Israel is the one country outside of those two regions. Take a look at the country breakdown and look at the number of companies represented by each. Ireland has only 7. Japan, 1,364, over a third of all the companies in the index. So some countries have a much more concentration than others, as we should expect. So even though VIU spans dozens of countries, the sector composition creates another layer of concentration investors should understand. How does an ETF like VIU with thousands of stocks look when examining the sector exposures? VIU, as a global developed market ETF, has a unique sector exposure compared to, say, the US or Canada, which is concentrated in very specific sectors like financials, energies, and materials. The top sector is financials, like it is in Canada, at 22.1% of VIU. Barely trailing that is industrials at 19.5% of the fund, and consumer discretionary, 10.5%. VIU's country mix makes for a fairly balanced sector breakdown. Now, when investors hear international ETF, they often imagine broad, equal diversification across every type of company. But the style profile tells a very different story. There's no surprise here as an MCAP index. The fund style is a large cap blended fund with 38% of the fund in large cap blended, 21% in large cap value, and 19% in large cap growth. It has about 17% exposure to mid caps, but doesn't have much exposure to small caps at just 4%. MCAPs, right? Vanguard breaks down the fund market cap like this: 70% large, 4% medium large, 12% medium, and 6% medium small, with 7% small. Each firm designates sizing in a different way, hence the difference in market cap sizes. This next section may sound boring, but it's actually one of the biggest reasons passive ETFs like VIU work as efficiently as they do. Let's dig into what exactly the FTSE developed All-Cap X North America Index is. It is part of the broader FTSE Global Equity Index series, or GEIS. It includes large, mid, and small cap stocks from developed markets outside of the US and Canada, as I mentioned. The index is derived from the FTSE GEIS, which captures 99% of the world's investable market capitalization. One reason passive ETFs like VIU work so well is because there's an entire rules-based system, constantly deciding which companies deserve inclusion and which don't. The index quietly removes weaker companies and adds new market leaders and adjusts weights over time without investors needing to do anything manually. The index is reviewed and rebalanced on a quarterly basis. Now, I'm not going to bore you with every FTSE rule, but the important takeaway is this: VIU isn't randomly selecting stocks. There are strict liquidity, MCAP, and investability requirements that determine which companies enter the index. That structure is one reason broad passive ETFs like this have historically worked so efficiently. And now we get to the section that matters the most to me, because none of the diversification, valuation, or historical returns matter if you can't emotionally survive the drawdowns. Investors like you and I are compensated for the equity risk and volatility we take on. That brings us to the risk profile of VIU. As I say with every fund you may be looking at, this is the part you'll want to especially pay attention to, whether you're a risk-adverse investor or not. This fund is labeled as medium risk. That means its standard deviation can be anywhere from 11 to less than 16. We saw reviewing VIU's annual, quarterly, and monthly performance, it can have quite the ups and downs. This is what investors intellectually understand, but emotionally struggle to tolerate. Here are some risk metrics of the benchmark index. Its 5-year SD, or standard deviation, is 12.8. Its 3-year is 13.9. It had a max drawdown of 27.7% in the last 10 years and 25.2% in the last 5. The index had a Sharpe ratio of 0.8 over the last 10 years. VIU's worst drawdown was in 2022 with a negative 23.2%. The other big one was in COVID, where it dropped 17.6%. What does this mean in practicality? Look at these underwater periods for those two drawdowns. The 2022 drawdown started in 2021 and ended in 2022. It was 1 year and 1 month long. But from peak to break even, it took 2 years and 4 months. For some, that is hard to hold through, or in the event you're retired, to sell at a loss throughout that entire period. The drawdown in COVID was fast, and the total underwater period was only 11 months. These are all month-end data points, so that we're clear. It can get much worse, though. The max drawdown in the last 20 years was a beast at negative 48.2% in euro. It was much worse in CAD because it appreciated against the euro by over 30%. It took almost 6 years to fully recover in euro. This is what being exposed to the FTSE developed markets looks like. Now, can you imagine how it feels? A 48% drawdown is one thing on paper. Living through it for nearly 6 years is something completely different. The real risk isn't volatility. It's abandoning your strategy halfway through the pain. Morningstar rates VIU as an aggressive fund with a portfolio risk score of 72. It has an average risk and above average return compared to its category. The beta is 1.04, with an R-squared of almost 100 and a Sharpe ratio of 0.69 over the last 10 years. Remember, VIU is dealing with currency conversion, tracking error, and expenses. That's why these numbers differ from the index. Not to be forgotten are the risk factors mentioned in the prospectus. They are country regional risk, investment style risk, and currency risk. Let me focus on this currency risk for a moment. Obviously, diversification in currency cuts both ways. There's a chance that the value of a foreign investment measured in Canadian dollars will decrease because of unfavorable changes in currency exchange rates. Currency risk is especially high in emerging markets, but still high in developed markets. You're not just investing in companies here. You're indirectly investing in currencies, monetary policy, and geopolitics too. For a quick recap, VIU is a Vanguard ETF that gives Canadian investors exposure to developed international markets outside of North America, including countries like Japan, UK, and Germany. It tracks a broad passive index of large, mid, and small cap companies, making it a popular way to add global diversification to a portfolio without increasing US or Canadian concentration. So after looking at the performance, diversification, valuation, concentration risk, currency exposures, and drawdowns, who is VIU actually built for? If you are looking for a core holding tracking the developed markets at a modest cost to diversify away from the US and emerging markets, this could do it. The irony of diversification is that it almost always feels unnecessary right before it becomes important again. Passive index ETFs like VIU are great for long-term investors that can withstand the volatility of an all-equity ETF in the developed market. Vanguard's VIU could also be added to an all-in-one ETF like VEQT to increase the developed market exposure. This fund may not be suited to you if you don't like market cap indices in general or are sensitive to currency fluctuations, especially the euro and the Japanese yen. Also, if you are cautious of heavy concentration in Japan and Europe's Big Four. VIU is a medium risk ETF that requires a stomach for volatility, so this fund may not be for you if you're a quite conservative investor. The opposite is also true. If you're looking for strong short-term performance or looking to follow the hot trends, this fund generally won't do it since it's an NCAP fund in the developed market. This fund isn't for you if you want tactical control of your portfolio's geographic weightings as opposed to just general broad exposure. Personally, I think VIU represents something many investors struggle with today. Accepting that good diversification often looks disappointing until suddenly it doesn't. Whether international markets continue this resurgence or not, VIU still solves a very real problem for Canadian investors: excessive concentration in North America. If you're looking into VIU, you're likely also looking at iShares XEF. You can check out that video right here.